For the last couple of weeks, GameStop, a struggling brick-and-mortar video game retailer, has been at the center of one of the financial world's biggest news stories. Activity by social media investors pushed GameStop's shares to major heights, forcing Wall Street hedge funds to pay up huge sums of money. The price of the video game company's shares have been extremely volatile alongside shares of AMC Theaters, BlackBerry and Nokia. After Wall Street Bets, a Reddit group, encouraged individuals to buy stock in these companies, resulting in stock prices skyrocketing. The social media rally is unprecedented in the financial world. FIU News caught up with Flavio Carrillo, director of FIU's Capital Markets Lab, to discuss what is going on with GameStop and the wider trend that is affecting the stock market. Can you explain what has been happening with GameStop stock recently? The story of what happened is not complicated at all. It starts with understanding the phrase, shorting. You can short a position in the stock market, which means selling something that you do not own. But then you must close that position also, which means buying that same position back at a later time. And so when hedge funds and institutions are thinking of shorting a position, they figure out, hey, here is a business that doesn't make a lot of sense. We can make money if we short sell its stock. The selling of shares should cause the price to go down. And then we could buy back the stock pretty much pennies on the dollar. Hedge funds were doing this to GameStop. And so these gamers and people on social media said, hey, we're going to revolt. We're going to start buying this stock. And so when GameStop stock started to rise, all of these short sellers had no choice but to buy at higher prices. It is called a short squeeze. When the short sellers were forced to buy the stock at higher prices, it exacerbated the situation because then the stock price rose even more. At that point, the market frenzy hit its zenith. Why do you say there is no economic viability behind this trend? GameStop operates in an industry that many consider to be in decline. They are in the brick-and-mortar video games industry, and that is slowly going away. Similar to what happened to Blockbuster Video not too long ago. You have many gamers who may have an emotional attachment to the company. But that doesn't change the fact that the firm itself is losing money. The company may likely be forced to cease operations in the near future. Are hedge funds really buying back GameStop shares at huge losses to close their positions? They do not really have a choice. Since they borrowed the shares that they sold, they are forced to buy them back. They have probably lost billions in the process. Is there a way for GameStop to receive the money flowing into its stock? Not unless they were making more shares available to the public. These are transactions that happen in the secondary market. A company gets equity capital when it goes public, either through an initial public offering or a subsequent public offering. These are transactions happening in the secondary market between buyers and sellers. Does it affect those closely associated with the firm? Sure it does. You have officers and other insiders that own stock trading at low values. And all of a sudden this happens and many of them experienced a windfall. But for the company itself, it does not change the fact that the business is not doing well.